Hi, welcome back to the series of videos on Ind AS, that is Ind AS with Accountsman. So today we're discussing part 3 of our Ind AS 16 video, that is property, plant and equipment. And in the previous video we had started discussion on how to measure PPE, and I told you it is dependent on when, that is initial or subsequent. And in the initial there is only one model, cost model. In subsequent we have cost or revaluation model. And in the entire previous day's discussion we had discussed the cost formula. Done. So we had discussed this cost model ka cost formula. So how do we use this cost formula in the cost model is what we're going to discuss today. And how do we go about with the revaluation model. If you have enough space in your class notes, you can write right below this here, but I'll use a new sheet to write this part. So what are we going to do in our cost model, and how would it be in our revaluation model? Yeah, so the point is pretty simple. In the cost model we will start with the cost of the asset that we identify using that formula. From this we deduct accumulated depreciation. Yeah, in your +1 +2 or second PUC or during your CPT or CA foundation days, you might have learned there are two methods of accounting for depreciation. That is one with provision, other one is without provision. With provision is where we write is a separate item in the liability side and don't deduct it from the don't credit it to the asset account. Yeah, so that is what we're going to follow. There is no concept of reducing the cost of the asset. The cost is unchanged because depreciation is again what is a provision. It is expected decrease, not the actual. So you cannot credit your asset account unless you sell it or unless you revalue it the same. So accumulated depreciation has to be deducted, or if there is any impairment loss. We'll discuss this in detail when we start in day 36. So that impairment loss, if it is there any, I'll write the number here. Yeah, so if that is there, that should also be deducted. So this is how we basically going to value our cost model. Under the revaluation model, we start with the revalued figure. Yeah, if I have to tell you in specific, revalued figure basically means the fair value under Ind AS 113. Yeah, so from this we deduct accumulated depreciation. Yeah, this accumulated depreciation is on the revalued figure. Like after the revaluation we should compute this, and then if there is any impairment loss, such impairment loss again should be further deducted, and that's how we arrive at this revaluation models figure, and this value will be the value that will be shown in our balance sheet for each year. Now the question is, which one should the organization follow, the cost model or the revaluation model? Yeah, option or selection is at discretion of organization, entity and management. You get that? So the management and the organization can choose among the cost model and the revaluation model, and they can follow that, but whatever they pick to follow should be consistent. Consistency is very much required. Consistency means not continuing the same model from one year to another year. You can always switch from cost model to revaluation model. Here the consistency is required within consistency within the class of assets, to be precise. Consistency within class of assets. Within the entire class of the assets there should be same model. Now assume when I take buildings, all the buildings I would have to either follow cost model or all the buildings I should follow revaluation model. It cannot happen like one building I'll follow cost model, one building I'll follow revaluation model. After saying this, I would have to tell you another important point, that when I say class of assets, it doesn't mean that all the buildings are not categorized in the same class. Now building has multiple purpose. Building can be used for the purpose of production. Building can be used in the process of administration. Now I have a factory building, I have an office building. Factory building and office building, though both are buildings, they are different class of assets. Now for all the factory buildings I can follow cost model, and for the office building I can follow revaluation model, or vice versa. That is allowed. But now assume that I have two factory buildings, factory building A, factory building B. Can I follow cost model for factory building A and revaluation model for factory building B? No. With the same class of assets you need to follow the same model. So for all the factory buildings one model, for all the office buildings one model allowed. So can I follow different models for each of the office buildings? Not allowed. So that is the significant understanding of this class of assets. There are theory questions on this in our material. Lot of times in a couple of RTPs also question has come. So if such kind of a question comes, you should not get deceived by it and then give wrong answer. Always remember, class of assets means doesn't just go by building. All the buildings are same class. No. The purpose for which that building is used will determine the class of that specific asset. Now we need to discuss couple of few items that have come here. The new items that have come here is, the first thing is we came across something called as accumulated depreciation. Impairment loss will not discuss it. We'll discuss in 36, but I'll tell you bit of it. And revalued figure. What do you mean by revalued figure? That we need to discuss. So we have three new terms to discuss. Number one, revalued figure. Number two, accumulated depreciation. Number three, impairment loss. So we'll start with revalued figure. We'll start with revaluation and then understand what exactly do you mean by revaluation, and then come to depreciation and then impairment loss at the end. So let me take you to revaluation. Whenever I say revaluation model, I am basically saying that the carrying amount is incorrect. So what am I going to do? I am not going to consider my carrying amount. The less importance will be given to the book value, and there will be significance value given to fair value. Or what am I going to follow? I'm going to follow the fair value approach. So the revalued figure, we're going to remove the book value and then write it the fair value of that specific asset. So the asset in the balance sheet will no more be shown at its book value. It will be shown at a value called as fair value. Now what exactly is fair value? This is regulated by Ind AS 113. We have to read it there. However, I'll tell you the parts of it. So whenever we talk about fair value here, this is determined based on the market based approach, or market based evidence we take, and based on this we determine the value, and professional assistance. See, we are not the best people to basically come out with the market based evidence. There are professional valuers or certified valuers. They will give us what exactly is the market value of this specific asset, and we'll take that value given by the professionals in the market, that is valuers, as the basis and determine our face value. If this is not available, then we go for discounting the income approach. This is that present value of cash flows that we follow. What we do in FM, we'll take all the future cash flows, take certain rate of interest, discount it at that rate, and that discounted amount is considered as our fair value. So this is what we do. So either of the options are there, that we'll discuss when to take this in our Ind AS 113. So this is how we basically go for valuation. So revaluation is done on fair value basis, and this fair value is done on market based evidence with professional assistance, or discounting of future income, or discounting of income in the income to be earned in the future, that is present value of future cash flows. So this is revaluation. And whenever we talk about revaluation, revaluation can be two types. Revaluation can be either upward revaluation, or it can be, or I can write it in red so that it looks like going downward. Or it can be downward revaluation, meaning upward in the sense, assume that my carrying amount of the asset is 100 and fair value gives me the value of 110. So previously the asset was recorded 100, now what I want to record it at 110. That is upward revaluation. The asset was recorded 100, but my fair value approach tells that the asset can be only 80 rupees. So I am reducing from 100 to 80, that is my downward revaluation. Both are correct. And whenever we do upward revaluation, what do we do? We basically create a reserve. The asset side balance sheet is increasing, so we increase the liability side. So we basically create revaluation reserve. You get that? So the asset has increased. Now the asset is 100. I am restating my asset from 100 to 110 by fair value approach. So balance sheet asset side has increased by 10 rupees. So the balance sheet will not tally now. So on the liability side, in the reserves and supplies, I write 10 rupees revaluation reserve. So my liability is also increased by 10, and my balance sheet will tally at a different amount now. That is higher of 10 rupees. Next, if it is downward revaluation, what do we do? Then the difference, whatever is there. Now 100 was the value of the asset. I decrease my asset to 80. So 20 rupees decrease. It will be written as expense to my P&L account. What do you say? treated, or I'll write debited to P&L straight away as expense. And this, whatever I told you now, is general rule, or I'll write it here. Yeah, so this is, ouch, a little below. Yeah, this is the general rule. This is not always applicable. What if the asset was previously revalued? Yeah, that's the important point. If asset is previously revalued and you're doing second revaluation now, then what will we do? We need to reverse the effect of the previous revaluation to the extent possible and then go out with the present valuation. Meaning, if the asset was previously revalued upwards, now you're revaluing it downward. Then what should we do? To the extent it was revalued upward previously, we need to reverse it. And then the balance will treat it as revaluation downward now. Or if the asset was previously downward revalued and now we're trying to revalue it upward, to the extent it was downward revalued previously should be reversed and the balance will be treated as upward revaluation. You get that? Or if previously revalued upward, now we're revaluing upward, now it's okay, upward only. If previously revalued downward, now also we're revaluing downward, it is the same. If it is opposite case, then we need to reverse it. Yeah, if the asset is previously revalued, then what should we check? Yeah, okay, I'll write here, see, previous, now. Okay, if previously the asset was upward revalued, yeah, now also we're revaluing upward, then what do? Simple, just do upward revaluation, don't worry. If previously the asset is upward revalued and now we're going to do downward revaluation, then we need to reverse it. Okay, what do? Reverse that upward, and then if there is excess, it will become downward. You get that? And if previously it was downward revalued and now also we're doing downward, then what will it be? It will be downward only, no change. If previously it was downward revalued and now we're doing upward revaluation, then what should we do? Then we should reverse it. Reverse the downward first and then excess will be done upward. Yeah, I'll draw a line here so that you'll understand which part relates to which part. Ouch, I moved myself, sorry. So this general rule is applicable for first revaluation. For subsequent revaluation, what do? Oh, sorry, I can write it way more cleaner, better. Yeah, excuse me for that. I was playing football yesterday and I twisted my wrist and my hand is little paining to write a little longer. Yeah, so in the case of subsequent revaluation, how do we do it? So first reverse earlier revaluation and then account for balance if they are opposite in nature. If they are both complementary in nature, then we know how to do it. So I just explained it to you with the help of that. If you want, I can actually take up an in detailed example to explain you the same. So that example would look something like this. So earlier, now. Yeah, what is the exactly accounting treatment? Now, if previously we've done upward revaluation by 10 and now we want to do upward revaluation by 5, then what will we do? So the accounting treatment will be very simple. We do upward by 5, no problem. Yeah, previously we had done upward revaluation by 10, now we're doing downward revaluation by 5. Now what will I do? Usually we're only concerned about this part now. Yeah, this is what we should account now. Usually what we do, downward revaluation means we debit it to P&L account, but in this case we won't do it. What will we do? This will be 5 to be reduced from revaluation reserve that was created here. From this 10, whatever the balance remaining, from that 5 will be reversed. what if there is no 5 rupees in that balance? To the extent it's available, it will be reduced and the balance will be debited to our P&L account. That's how we do it. And the next case, what if our previous revaluation was downward by 10 and now we're doing further downward by 10? Then the answer is pretty simple. I'll do downward by 5. What is it? Here we do revaluation reserve. Here I'll write debit to P&L. Here 5 rupees to be adjusted against revaluation reserve. If revaluation reserve balance is not available, to that extent P&L. And what about in this case? Let's go to the next case where it is downward by 10 and further what I'm doing is upward by 5. Usually this upward 5 should have been transferred to revaluation reserve, but I'll not transfer to revaluation reserve anymore. I will debit this to P&L account. Previously debited, now I'll credit to P&L. Previously debited, now I'll credit, it will get adjusted. You get that? Next comes our very important case. So previously there is increase of 10, now there is decrease of 15. So what will I do? To the extent it's there, I'll adjust it to revaluation reserve, balance will go here. Assume that this is the very next year and 10 is also available in our revaluation reserve. So what will I do? What I'll do is 10 to be reduced from revaluation reserve and 5 to be debited to P&L. What if in my revaluation reserve balance available is 9? So 9 rupees I'll reduce from my revaluation reserve and balance 6 will go to my PL. I hope you understood what I'm trying to tell. So what we'll do is we will first reverse the earlier treatment that we've done and the balance will be accounted as we've discussed previously. So that is how we basically go for revaluation. And the next important point is how often should we do revaluation? How often do we do revaluation? That depends upon the volatility of the asset. So PPE, yeah, we need to check the volatility. Yeah, so I'll write here volatile. Yeah, not volatile. There is significant changes happening to the asset throughout, so that is volatile. There is not significant changes happening, it's almost like same, then it is not volatile. If it is very volatile, then we need to do revaluation. Okay, I'll write here. We need to do revaluation annually. Annual reassessment. And we need to do revaluation. If it is not very volatile, what do we do? Then we can opt to do once in 3-4 years. Once in 3 to 5 years. Once in 3 years or once in 5 years, we can do the revaluation of this specific asset. So when we do revaluation, we know how to basically go with that particular part. So that is what we discussed till now. Next, what do we do with this revaluation reserve? What to do with revaluation reserve? It is okay if the asset is downward revalued, it will go to P&L account. What we need to remember is whenever the asset is revalued, can I give dividend with the same? Can I give bonus issue with this reserve using capitalization? So the answer is no. There is no possibility of dividend, there is no possibility of bonus issue because this is not a free reserve. You get that? Only thing that we can do with respect to this is, yeah, transfer this to other comprehensive income. You get that? Transfer to other comprehensive income. Can I transfer it all once? No. Wait, let me complete. Transfer this to other comprehensive income over the remaining useful life of the asset. Yeah. Usually it can be appropriated to that increase in the depreciation. Now whenever we assess the asset, whenever revalue the asset and increase the asset value of the asset, revaluation reserve will be created. When we increase the value of the asset, that will lead to increased depreciation. That increased depreciation will be debited to my P&L. So to compensate that, the reversal will be in other comprehensive income credit. And income will be recorded in other comprehensive income. So what will this do? This will reverse the additional depreciation arising on upward revaluation. So this will basically reverse the additional depreciation that is created on increase in the value of that asset. So this is how we treat with respect to a revaluation reserve. So all we've done till now is we've discussed both revaluation value as well as the cost model. Now Now we need to discuss our concept of depreciation. What exactly do we mean by depreciation? When do we compute depreciation? How do we compute depreciation and everything? So let us go to the last part of our Ind AS 16 PPE. So that is depreciation. Yeah. What do we mean by depreciation? Depreciation is decrease in value of asset. It is decrease in the value of the asset. This decrease in the value of the asset is due to multiple reasons, like wear and tear, you're using the asset, yeah, or what to say, effluxion of time. Even if you don't use it, by passage of time there will be depreciation. Or new technology, when the new technology comes in the market, the value of the old technology will come down. Or what is a change in the fashion, change in the trend, change in the user needs, or a lot of other factors. So those are the things that we read from our basics. So depreciation is the decrease in the value of the asset. So whenever we talk about depreciation, depreciation is based on what? Ouch. Depreciation is based on two important items. Yeah, number one is useful life. This is expected. We cannot tell exactly as to how many years can you use the asset. So when you look at the asset, I tell 6 years, that is expectation. And the next one is scrap value or estimated residual value. So these both are expected items. So can I tell that both of these items are accounting estimates, and based on this is how I am basically determining my depreciation. So as both of them are accounting estimates, change in useful life or scrap value, whenever these change, depreciation amount should change, because this will change the depreciable amount. So whenever there is change in them, it would be change in accounting estimate, and it should be accounted for prospectively, meaning you need not go back to past and then change it, should change from the year in which this change is happening. So I've been telling you repeatedly that depreciation is based on the useful life and scrap value. How is it? Yeah, let me explain it to you. We have an important component called as depreciable amount. This depreciable amount is identified as cost minus scrap value. Scrap value is the estimated value of the asset at the end of its useful life. Yeah, not resale value. At the end of the useful life, that is the purpose for which it was intended to be used. Whatever value that we get is our depreciable amount. So cost minus scrap value is depreciable amount, and this is the amount that will be transferred to P&L. So this is the amount to be depreciated, like this is the amount to be transferred to P&L over the useful life of the asset. So to be transferred to P&L over useful life of the PPE. So when this changes or this changes, the depreciation will change. You get that? Now what is the basis for depreciation is the next point. Basis for depreciation. You get that? So basis for the depreciation is basically, okay, pattern of future economic benefits arising from that specific asset. So we take the cost, subtract the scrap value, whatever the depreciable amount that we get, it will be allocated over the useful life equally or in diminishing balance. That depends upon the pattern of future economic benefits. Using the asset, if you're going to get equal benefits every year, then the depreciable amount will be written off equally. If there is going to be diminishing in the economic benefits that will be arising, then in the decreasing order we'll basically write down that particular item. Or if it is dependent upon the production of the units, we go by that. What we need to note here is there is no specific depreciation method given. Yeah, depreciation method is not mentioned by the standard. We basically go by the pattern of usage or pattern of the economic benefits. So whichever pattern it goes by, we'll go with it. SLM or WDV or production units or machine hour rate. So whatever is the pattern of the economic benefits arising from that specific asset, in that pattern we depreciate that specific asset. Last part of our discussion is when do we start the depreciation and when do we finish the depreciation. So depreciation. When do we start the depreciation and when do we stop the depreciation? Yeah, the depreciation would be started when the asset is ready for use. Asset is ready to be put to use. Now assume that the asset is ready to be used today, but someone says that it's not a very good day, it's close to eclipse, or it is some, what to say, some no moon day or something, you need to postpone and we'll start using it after 1 month. That's not counted. The day when the asset is ready to be put to use, from that day only you should start computing the depreciation. Now the question is, when do we stop the depreciation? The first point when we stop the depreciation is, guess, yeah, sale or disposal. When I sell that asset, I don't have the control over that asset anymore, so I might stop. I should definitely stop charging depreciation. So the second part is, when do we stop charging the depreciation on the asset? Yeah, when the asset is not in active use. Not in active use. What exactly do we mean by not in active use? Or I can tell in the other terms, or the carrying amount of the asset is lesser than the residual value. Meaning, if I sell the asset right now, I will realize some 5,000 rupees. But after depreciating, the value of the asset in my books is 4,000. So if I further depreciate it, it's not correct. No, if I sell right now, I can recover 5,000. So there is no depreciation in the asset. So you should stop depreciation at this point. When the carrying amount is lesser than residual value. You get that? If the carrying amount is lesser than residual value, at this point, asset can be treated as NCA HFS. What is NCA HFS? It is Ind AS 105. Yeah, I've mentioned this NCA HFS previously, if you can remember. That is non-current asset held for sale. Then it will be valued at its book value. Valued at its realizable value. So that's one point. Lot of them usually have a small confusion here, saying that, sir, if my carrying amount is lesser than fair value, should I stop depreciation? Should I stop depreciation? Yeah, you need to note that I told you that you need to stop depreciation when the carrying amount is lesser than residual value, or what to say, that realizable scrap value, not when it is lesser than fair value. When the carrying amount is lesser than fair value, then what should you do? Maybe you should go for, what to say, revalue asset and continue depreciation. You get that? Just because the fair value of the asset is more and you already depreciated it more, that doesn't mean you'll stop depreciation. Then you revalue your asset and continue depreciation. You cannot you cannot stop depreciation forever. You get that? Depreciation has to be recorded, but you can switch to, what to say, the revaluation model. Yeah, this is the discussion with regard to our depreciation concept. Yeah, I hope we've covered everything that is basically required to be noted with regard to our depreciation also here. Yeah, it's a little long standard. We did discuss every other point that's very much required, and this is also very important regarding that revaluation thing. So I hope you understood the entire Ind AS 16 PPE in detail. Yeah, see you all in the next standard. Till then, stay in the game.